They called me crazy when I said I would access the most powerful wealth-building ETFs on the planet. They said it couldn't be done from Europe. They said the regulations were too strict. But here I am, sitting on a six-figure portfolio filled with the exact same explosive US ETFs that supposedly only American investors can access. As an example, TQQQ. Welcome to the forbidden knowledge that financial advisors don't want you to have. How to legally buy US ETFs from Europe, even with all the PRIIPs and UCITS regulations standing in your way. Welcome to Psycho Investor, where we don't just accept the limitations placed on European investors, we find calculated strategic ways to overcome them. I'm not here to tell you about settling for the watered-down UCITS versions of ETFs with their higher fees and lower performance. I'm here to show you exactly how to get your hands on the real deal, those juicy US ETFs that supposedly only Americans can access. But let me be clear, this isn't about using shady brokers or breaking regulations. This is about using sophisticated but perfectly legal methods that most European investors simply don't know about. First, let's understand exactly why we want access to US ETFs in the first place. There are four main reasons why these ETFs are superior to their European counterparts. First of all, lower expense ratios. US ETFs typically have much lower expense ratios compared to their European UCITS equivalents. Let me show you some direct comparisons. For example, US version expense ratio, European version expense ratio, S&P 500. Ticker BOO, its expense ratio is 0.03%. For example, European version expense ratio, VUSA, is 0.07. So Europeans are paying double the price that Americans pay. Same with Nasdaq 100. QQQ is priced at 0.2%. EQQQ European version has 0.33% expense ratio. Total market BTI is priced at 0.03% in America. BWRL is priced at 0.22%. So basically it's 7 times more expensive than American version. These differences might seem small, but over decades of investing, they compound into tens of thousands of euros in lost returns. Second reason, better liquidity and tighter spreads. US ETFs trade in the world's deepest, most liquid market. This means tighter bid-ask spreads, lower market impact when trading, better price execution. For example, QQQ, the US Nasdaq 100 ETF, trades over 20 billion in daily volume compared to just 200 million for its European equivalent EQQQ. This 100x difference in liquidity translates directly to your bottom line through better execution. Third reason, access to specialized ETFs that don't exist in Europe. And fourth reason, tax advantages. Certain US ETFs can actually have tax advantages for Europeans, particularly when using the option strategy I'll show you today. No US dividend withholding tax on option premiums, no currency conversion costs on dividends, and potentially more favorable tax treatment depending on your country. Now that you understand why we want these ETFs, let's talk about how to actually access them. To implement our strategy, you'll need the right brokerage account with specific permissions. Not all European brokers offer US options trading. Most popular broker is Interactive Brokers. This is my top recommendation and what I personally use for options trading specifically. Available across Europe, UK with low fees. So let's start with account setup process. Here's the step-by-step process to get your IBKR account ready. First, open an account. Individual account is fastest. Second, complete identity verification. And third, fund your account. The critical part, level 3 options trading permissions. This is where most people get stuck. You need level 3 options trading permissions specifically. Here's exactly how to get it. First, log into your IBKR account. Second, go to account settings and trading permissions. Third, select options trading. Fourth, request level 3 permissions. And fifth, complete the options knowledge quiz. When filling out the application, you'll need to demonstrate some options knowledge. Here's what I suggest. For trading experience, 2 to 3 years minimum. For knowledge level, good or extensive. For previous trades, 20 plus options trades per year. And investment objectives include growth and income. Be honest, but don't understate your knowledge. The broker needs to know you understand the basics of options trading before approving you. You'll typically get approved within 1 to 2 business days. One more critical step that many miss: optimize your currency conversion. Rather than depositing EUR and letting the automatic conversion happen when you trade, use IBKR's Forex platform to convert your currency manually. This saves up to 0.5 to 1% on each transaction. Here's how. Deposit euros to your account. Go to Convert Currency tool, then convert USD manually using a limit order, and now you have USD ready for US options trading. This simple step saved me around 300 euros on a 40,000 conversion. Now that you have your account set up with the right permissions, let's understand why options are the perfect workaround for European ETF restrictions. While PRIIPs and UCITS regulations prevent European retail investors from directly purchasing US ETFs, they don't restrict trading options on these same ETFs. This creates a perfectly legal pathway to gain exposure to these ETFs through options contracts. The regulation specifically blocks direct purchase of ETF shares because they lack the required Key Information Document, or KID. But options on these ETFs fall under different regulatory category, which is accessible to European retail investors with the right permissions. For those who might be new to options, let me quickly cover the basics. Call options give you the right to buy shares at a specific price. Put options give you the right to sell shares at a specific price. Buy, long, you pay premium to gain rights. Sell, short, you receive premium but take on obligations. There are multiple option strategies we could use to access US ETFs, including deep in the money call options, synthetic long position, and cash secured puts. I found that cash secured puts offer the best combination of simplicity, income generation, and potential ETF ownership for European investors. So let me introduce you to the simplest, most powerful option strategy for European investors to gain access to these forbidden US ETFs, the cash secured put. Here's how it works. You sell short a put option on the US ETF you want exposure to. You receive premium cash immediately to your account. You set aside cash equal to the purchase obligation, strike price times 100 shares. If the ETF price falls below your strike price at expiration, you'll be assigned shares. If the ETF stays above your strike price, you keep the premium as profit. The beauty of this approach is its simplicity. It's a single options contract, no complex spreads or multiple legs to manage. Now let's break down the key elements of a cash secured put. Strike price. The strike price at which you are willing to buy the ETF. Expiration date. When the contract expires. Typically 30 to 180 days out. Premium. The money you receive upfront for selling the put. And collateral. The cash you must set aside. Strike price times 100 times number of contracts. For example, if you sell a 50 strike put, you need 5,000 in cash collateral per contract, representing 100 shares. There are only two things that can happen with a cash secured put. First, ETF price stays above strike price, and then option expires worthless. You keep the full premium and you can sell another put if you wish. Second, ETF price fall below strike price, you're assigned shares at the strike price, which is exactly what you wanted to own the ETF. Your effective purchase price is the strike price minus the premium you received. Either way, you win. You either get paid to wait for a better entry price, or you acquire the shares at a discount. For those who might be intimidated by options, here's the simplest way to understand a cash secured put. It's exactly like a limit order, but you get paid for placing it. For example, traditional limit order. You set a price below the current market price. You wait for the price to drop to your level. If it drops, you buy the shares. If it doesn't drop, nothing happens. Same with cash secured put. You set a price below the current market price, strike price. You wait for the price to drop to your level. If it drops, you buy shares. If it doesn't drop, nothing happens. But you get paid a premium upfront either way. This is why cash-secured puts are so powerful. They are essentially limit orders that pay you for your patience. Think about it. With a standard limit order, you are willing to buy an ETF at a specific price, but you get nothing while waiting. With a cash-secured put, you are doing the exact same thing but collecting premium while you wait. It's like getting paid rent on the cash you have set aside for future investments. Now let's walk through a hypothetical example using one of my favorite ETFs that's unavailable to European investors, TQQQ, the triple leverage Nasdaq 100 ETF. Let's say TQQQ is currently trading at $65 per share. Step 1. Decide your entry price. First, I decide what price I'd be happy to buy TQQQ. Since it's a volatile ETF, I might want a significant discount, let's say $55, which is about 15% below the current price. Step 2. Check the option chain. I look at the option chain for TQQQ and find put options with a 55 strike price. I see several expiration dates available. 30 days out, $1.8 premium. 60 days out, $3.2 premium. 90 days out, $4.5 premium. For example, I'll try with the 90-day option in this example. Step 3. Calculate the returns. For selling one TQQQ put contract at 55 strike expiring in 90 days, premium received is 450, 4.5 times 100 shares. Cash required as a collateral, 5,500. 55 times 100 shares. Return if TQQQ stays above $55 is 8.2% in 90 days, about 33% annualized. Step 4. To place this trade, go to the options chain for TQQQ, select the put option with 55 strike and your chosen expiration. Choose sell or write, enter the quantity, one contract is equal 100 shares. Use a limit order at slightly above the current bid price and submit the order. Now let's look at the two possible outcomes. If TQQQ stays above 55, your put expires worthless. You keep the entire 450 premium and your return is 8.2% on capital for 90 days. You can sell another put if you still want to acquire TQQQ. Scenario 2. TQQQ falls below 55. You are assigned 100 shares of TQQQ at 55 per share. Your effective purchase price is 50.50, 55 minus 4.5 premium. You own the forbidden US ETF that Europeans supposedly can't access, and you can start selling covered calls on your shares for additional income. Either way, you've successfully either generated substantial income or acquired a US ETF that's supposedly off limits to European investors. So let's take a look at the screen share where I will show you what to do exactly and how to place an order for cash secured put. In this case, I will use TQQQ. So in the search field, you just type TQQQ, select options, and you will have this window that I'm looking at. On the right side, you can see that TQQQ is now trading at $46. And for example, I want to buy it at $40 strike price, so you have the current price here. I would like to buy it for $40 and I want to set up order to cash secured put. So on the right side, I found put and then I find sell button. Here, I press this one and now I can see that max return which I can get is 325, max loss is 3,662 and break-even price is $36. What does these numbers mean? So basically, max return is what I'm getting in a premium right now to my account. Break-even price is if cash secured put is applied in 28 days on May 9th, my purchase price for TQQQ would be $36.74 per share. So I am buying at 40, but the premium compensates for the lower price. Max loss, so this is amount of money I need to have in my account in order to place this order. So I'm scrolling down, I can see another metrics, you can explore them on your own. Now I'm going to order, then I need to put my limit price. And now I see that TQQQ bid is 3.2 and ask is $5.1. So now I am going here, choose my limit price. I will choose something like between 320 and 5.55. I will try with $3.7 per one, so my premium would be 370 because I'm buying 100 shares. And what I should click is sell order here on the bottom. Let's try limit, sell order. Your order has been submitted. So now I just placed an order. If order will be executed, I will receive 370 to my account and I will have the opportunity to buy 100 shares of TQQQ from Europe absolutely legally at the lower price than $40, which is my strike price. Probably it will put me at around $36.3. So if you want to try this strategy, it's as easy as it was for me. If you want more education on options, you can try Options Wizard from IBKR, so it will help you to go through your options. Now let's get back to conclusions. So there you have it, the complete guide to accessing those forbidden US ETFs from Europe using cash-secured puts. This strategy gives you the ability to generate substantial income while waiting to buy at your target price, legally access US ETFs that are supposedly off limits to Europeans, and create a systematic approach to building your ideal portfolio. Also, potentially acquire shares at prices below current market value. Remember, this isn't about taking crazy risks, it's about using a sophisticated yet straightforward strategy to access investments that others can't reach. This is the difference between average investor and psycho investor. For beginners, start with just one cash-secured put on a stable ETF like SPY or QQQ. Set a strike price 5 to 10% below the current market price, use a 30-60 day expiration, and see how it feels to generate immediate income while potentially gaining access to these powerful US ETFs. If you want to take your investing to the next level with these strategies, smash that subscribe button right now. Drop a comment below with which US ETF you are most interested in accessing through this strategy. Is it TQQQ for leveraged exposure? Is it JEPI for monthly income, or something else entirely? This is Psycho Investor, and I'll see you in the next video. Stay psycho, stay profitable.